an even higher angle in terms of rise over run. You are in less time getting more money added to the system. And then here, after COVID, we appear to have taken off at an even bigger angle. And how I would say that that is confirmed is I would draw in kind of a top trend line here and say, okay, this is our phase 3. And as long as we come up here and stay somewhere in here, you know, we're still at this same sort of rise over run. But here, now, boom, look at this. This is much different. This is a much different angle. And this is an angle that is a terminal angle. This is 90 degrees. If you think of phase 4 of a hyperwave, it's not always 90 degrees, but it's usually darn close to where this seems ridiculous and unsustainable, but it's not 90 degrees. And until you get up to that 90 degrees, you can always accelerate at a much higher rate of return or rise over run. And here, what we are seeing is a big fundamental event and then a change in the angle that the money is being printed. And now what we're going to want to do is compare that to the angles of the trend lines in the S&P 500. And also just kind of keep this chart in mind right here as I am arguing that this is the most correlated chart to the S&P 500 is the chart of money supply. There we're specifically looking at M2 money. So here we're going to go back to, this does have more history that shows that this would match up very, very closely, as far as I'm concerned, with money supply in the 70s, 80s, just, you know, sideways. And then all of a sudden here, something happens, and around 82, we take off at this angle, and then we enter the real dot-com bubble, where that happened right in there. Everybody's familiar with that. So here, if we extend our phase line, this one right here, this was where that following crash ended up finding support in 2008. And that was where the money printing started again. So we accelerate at a higher rate of return. And I've been looking at this ever since I learned hyperwave theory, along with Leah and Tyler. We were really looking at this as, is this our phase 4 right here? We look to clearly be accelerating at a higher angle. And furthermore, let's draw in our kind of top trend line. We break through that definitely here, but for sure here. So right here, I was absolutely thinking phase 4 is starting. And this was something that is specifically written in the book. We were writing the book in here, and we say, if this creates a new all-time high, then watch out for phase 4 to start. We didn't say for sure it's going to happen, but we said that that's probably the most likely situation, and that we're going to pencil in a phase 4 line. That's a very important kind of concept, is that when you get good evidence that this trend line is no longer being respected, and that maybe a higher rate of return is, well, now you can't be, say, 100% certain that phase 4 is starting, but you've got enough evidence to go ahead and pencil it in. And that's when I will kind of draw it with a dotted line, which, if you've seen my recent charts, me drawn in phase 4, it's all been with these dotted lines. So I'm penciling it in. It's an idea that has a lot of validity right now. And the concept that I wanted to be sure to touch on here, I guess without having to, oh, nice, I don't have to pull up a new chart. What I'm really wanting to take a look at is, so why didn't this start phase 4? Well, maybe it was because of COVID. That's what I thought, was that, yeah, we were going phase 4, but then COVID started and that stopped it all. Now I'm thinking that, well, we didn't enter phase 4 because the money printing was all the same. If the money printing is the number one reason why the S&P is valued at what it is, then it was going to continue at its rate of return, at its rise over run, as long as the money printing was continuing at that. And if I was to think about, I couldn't have thought about this beforehand, because I wouldn't have been able to think of a situation where the Feds would start printing a ton of money and it's still like phase 3, like it's still, we're at the top, opposed to after a crash. I never thought that we'd see a tremendous amount of money printing when we're still in the upside of a hyperwave, opposed to breaking it down like we did in 08 or 02. So now, after seeing this chart, I am starting to think, well, we didn't enter phase 4 in the S&P here because there wasn't enough new money coming into the world to justify those prices. And now that we have started to see this change in the rise over run of the money printing, now I'm really starting to think that the S&P should follow at a very similar angle, and that is now kind of what we're seeing if we take this over like that, something like this. And of course, we're going to have to drop that just a little bit. So now that angle of a phase 4 would be perfect. And then it really lines up with this angle of the money printing. And that isn't even starting to take into account all of the extra money that's on the sidelines that you guys were mentioning, all of the short sellers that might get squeezed out, and then all of the people, the investment managers who sold, rightfully so in my mind. But then if they get left behind, and then you've just got a race of people trying to buy back in, that's where you get that kind of melt up phase that you were talking about could be possible. So that's what I am now starting to think is not only possible, but more likely than not. So would definitely be curious to get both of your opinions on the correlation between the money supply and the price of the S&P 500.